Have you ever wondered why the stock market suddenly crashes, as if out of nowhere, while everyone else seems shocked? What if I told you that the warning signs were always there, just not where most people were looking? Because the truth is, the Forex market, the global $7.5 trillion a day network of currency traders, often predicts stock market collapses months before they happen. When you learn how to read it, Forex becomes the world's most accurate crystal ball. Let's start with a simple idea. Every stock, bond, or commodity in the world is priced in a currency. That means before a stock moves, money moves. And the foreign exchange market is where that movement begins. Think of it like the bloodstream of the global economy, trillions of dollars flowing every single day, carrying information, capital, and risk sentiment across continents. When the bloodstream slows, tightens, or shifts direction, something big is about to happen in the body. So how exactly does Forex front-run stock markets? Let's go back to the early 2000s. Before the dot-com bubble burst, the Japanese yen started strengthening months ahead. Investors were unwinding risky positions funded through cheap yen loans, a signal that global risk appetite was collapsing. Stocks followed the same path later, but by then, the Forex market had already screamed its warning. Fast forward to 2008. Long before Lehman Brothers fell, the US dollar and yen both surged, a clear risk-off signal. When traders flee to safety, they rush into those currencies. The pattern repeated in 2015 with China's yuan devaluation, again in 2020 before COVID's global market meltdown, and even in 2022 when the dollar's violent rally foreshadowed one of the fastest equity drawdowns in modern history. These weren't coincidences. They were currency-based predictions, hidden in plain sight. Here's why. Currencies are pure expressions of capital flows. They react instantly to changes in global growth, interest rate expectations, and fear. Stocks, on the other hand, lag. They depend on quarterly reports, sentiment, and headlines. In Forex, you're watching the real-time heartbeat of global money. One of the most powerful leading indicators is US dollar to Japanese yen, the pair that tracks global liquidity. When it rises, risk is on. When it falls, risk is off. Historically, every major crash from 2008 to 2020 began with a sharp yen surge. Why? Because the yen is the funding currency of the world. Hedge funds borrow in yen to invest in risk assets. When they panic, they buy yen back. That flow destroys risk sentiment across the board. You can see it in the data. During 2007, while the S&P 500 was hitting record highs, the yen quietly began strengthening. The carry trade was unwinding. Within 6 months, equities collapsed. The same happened in 2018, when US dollar to Japanese yen started falling before the Volmageddon crash. Again in 2022, yen strength and dollar surges screamed tight liquidity months before stocks cratered. Another major signal is the dollar index, DXY. A rising dollar almost always signals tightening financial conditions. Emerging markets crumble, commodities fall, and global investors scramble for cash. By the time the stock market reacts, the damage is already done. But here's where it gets fascinating. The dollar doesn't rise just because of strength, it rises because of fear. When investors expect slower growth or global dislocation, they hoard dollars. It's not optimism. It's preparation. And it's measurable. During the 2022 tightening cycle, the dollar gained nearly 20% in under a year, one of the sharpest moves in history. Stock markets around the world fell 25 to 30%. Once again, Forex led. This predictive power extends beyond the US too. The euro to US dollar pair is another key barometer. A falling euro signals declining global trade momentum and industrial weakness, usually the precursor to global equity drawdowns. When Europe's currency weakens, it tells you that demand across manufacturing hubs is drying up. Then there's Australian dollar to Japanese yen, the ultimate risk thermometer. Australia's dollar represents growth in commodities. Japan's yen represents safety. When Australian dollar to Japanese yen plunges, it means traders are dumping risk for safety. This pair has front-run every global downturn since 2001. Let's test this theory against real data. In February 2020, before COVID lockdowns began in the West, Australian dollar to Japanese yen had already collapsed 8%. Global equities followed weeks later. In 2008, Australian dollar to Japanese yen fell over 30% before the S&P even realized what hit it. And in 2022, It began falling in April, months before equity volatility exploded in June. Currency traders weren't guessing. They were seeing capital flows shifting from risk to protection, live in real time. The same story unfolds with emerging market currencies. When the South African rand, Turkish lira, or Brazilian real start to weaken dramatically against the dollar, it signals capital flight. Investors pulling money from high-yield, high-risk economies back to safe havens. That flight usually happens long before equities crash. And then there's the Swiss franc, another safe haven. When CHF strengthens sharply, it means investors are hiding. Every major crisis, 2008, 2011, 2015, 2020, saw massive inflows into the franc before stock markets fell. Now you might wonder, why do these patterns repeat? Because fear always moves faster than fundamentals. Currency markets reflect that fear instantly. When global investors sense tightening liquidity, central bank hawkishness, or political instability, they reposition immediately through Forex. Stocks can't respond that fast. They need confirmation, data, and corporate guidance. That's why macro hedge funds obsess over currency correlations. They know, if you want to see where markets are heading next, watch Forex first. Consider interest rate differentials, another predictive weapon. When the gap between U.S. and global yields widens, the dollar surges. When it narrows, the dollar weakens. These shifts happen months before equity investors react. In fact, many algorithmic funds use Forex signals to front-run stock volatility. They don't wait for earnings or news. They read the global money flow directly from exchange rates. But the most powerful indicator of all, the breakdown of correlations. Normally, when stocks rise, high-yielding currencies like the Aussie or pound rise too. But when that relationship suddenly flips, when currencies start weakening even as equities hold steady, it's often the calm before the storm. This happened in 2007, 2015, 2018, and 2022. Each time, currencies broke correlation first. Stocks broke later. And here's something few analysts mention. Forex not only predicts crashes, it also predicts recoveries. After every panic, currencies stabilize before equities bottom. In March 2009, the dollar peaked weeks before stocks rebounded. In March 2020, Australian dollar to Japanese yen bottomed 10 days before the S&P 500 turned up. In October 2022, as the dollar index rolled over, equities staged a massive rally. The currency market always moves first, because currencies are the most liquid, most forward-looking assets on Earth. They price in central bank policy, growth expectations, and geopolitical risk faster than any other market can. So if you want to see the next stock market crash before it happens, stop watching CNBC headlines. Watch US dollar to Japanese yen. Watch Australian dollar to Japanese yen. Watch DXY. Look at where global capital is flowing. When investors dump risk currencies for safety, when dollar demand surges, when yen rallies and emerging markets crumble, that's your early warning system. In those moments, the Forex market isn't just reacting, it's screaming, something big is coming. It's a message for those who know how to listen. So the next time everyone says a crash came out of nowhere, you'll know better. Because the truth is, Forex whispered the secret months in advance. And if you want to navigate that storm like a professional, stay curious, stay informed, and never ignore the signals hiding in plain sight. If you found this fascinating, make sure you like, comment, share this video with a fellow trader, and subscribe for more deep dives into the financial world's hidden patterns.